Thank you very much, Ian and Joel. It gives me great pleasure to introduce the next session, and I'd just like to take this opportunity again to thank all of our partners and sponsors. I mention that because the host of our next session, Jim Fischer, partner at DLA Piper, is one of the very best partners that we have. I have the pleasure of working with Jim and also his colleague Luca in London. So I'll welcome Jim to the stage, who's going to be talking about IPO readiness with Barrie Laver, MD, Head of Venture Capital and Private Equity at RBC. Gents.
Good morning. Thank you for joining us. Barrie and I sat on this stage a year ago, so many of you might have seen us, and we appreciate you coming back to see us. Jim Fischer from DLA Piper. I am a M&A partner and CVC partner with the firm. We are a global law firm of lots of offices in lots of different places, so enjoy this conference very much and the sponsorship across not only this platform, but various other GCV platforms. Barrie, maybe a minute on you and RBC, and we'll dive in.
Yeah, Barrie Laver, as I said, I run venture capital private equity for the Royal Bank, Canada's largest company. We are a strategic investor investing from the balance sheet, so shareholder money, so to speak. We are active both in direct investments where we see strategic rationale for the bank, and we are also active fund investors across a number of sectors, but with our largest individual allocation in climate, where we are looking to support the climate strategy for the bank. As a very active participant in the oil and gas sector in Canada and Canadian markets, it's an important part of our overall strategy. So my background is primarily venture. It's my third time with the bank over just a few decades, always in the venture area. And so great to be here. Thank you.
So what we thought we would do is just kind of level set a little bit. Last year we sat here coming out of 2024. We all had sort of a vision of what 2025 might look like. By the time we got here, I'll speak for myself, my vision of what 2025 was going to look like didn't look like 2025 at that particular time. And so we thought we would kind of go back and recap a few things and see kind of what we said on this stage last year and what kind of happened. We had the benefit of actually looking at the tape and sort of really diving into that. So I'll just start by asking a really kind of basic question. We sat here last year in March of 25. First quarter was rough. After we left the stage, you went back to Canada and I go back to New York. What did the balance of 25 look like, and did it actually mirror what we thought when we sat here in March of last year from the bank's perspective, obviously?
Well, it certainly didn't mirror my expectations. We were maybe a week from here last year when we had Liberation Day, which introduced a level of uncertainty to the markets, which sort of also immediately instituted or started a bit of a mini market crash, I guess I'd say, and you saw in the public markets. And I'd say in the first week of April, there was a lot of uncertainty about how things were going to shake out. And so the rest of the year for me was quite surprising. When you saw the way the public markets were on a bit of a tear all of the year, it was quite incredible. It was a pretty consistent path up for the balance of the year across markets. And then the other part of that sort of surprised me is typically when the markets are that strong, we did start seeing a little bit of IPO activity open up towards the latter part of the year. But I personally didn't start seeing any of that trickle down into the private markets other than in a couple of sectors. You really didn't see it trickle down in the private sector or private markets. And I would have, if you'd told me in April in terms of how the markets would prepare or would it act for the rest of the year, I would have expected to start seeing more distributions out of our portfolio. But in fact, if I look at it on an overall basis, rough numbers, we, as a percentage of NAV, we probably saw 1.5% to 2% in terms of cash flow back in terms of distributions, which is lower than I might have guessed with the strength of the public markets. So.
Yeah, and just having looked back at last year and what we were talking about on the stage, there was a sense of pessimism, frankly, not really understanding what would happen, not really knowing about exactly what would happen with Liberation Day and thereafter. And you did sort of see this pretty remarkable, at least in the private M&A markets, steep rise in sort of activity. Do you think your experiences, the bank's experiences, were sort of typical from where you sit both geographically and where you invest geographically, and just as one of the largest financial institutions in the world?
I think so. First of all, we have a pretty broad-based portfolio across both directs and funds, as I said. And our fund portfolio, while a lot of it has a nexus to Canada, we do have a fair number of non-Canadian funds in the portfolio. And across, I'd say, 90% of the funds we saw in 2025 that were in market, fundraising activity was still very slow for them. Like first closes were deferred, size of first close was lower than anticipated or planned. So everything just seemed to take longer. Now, for the extremely well-established, successful funds that have a history of distributions back to LPs, that was not so much the case. But across most sectors and most funds, that was the case. So I think our lens on the market was pretty uniform and consistent with what others saw.
Yep. I get asked this a lot by clients, by just conversation. What surprised me about the VC markets, the capital markets, the M&A markets in 2025. My view of that in terms of what surprised me, but I'm curious for the audience, what surprised you, sort of the balance of the year, and maybe was different than what you had anticipated, again, as we left the stage?
Well, M&A volume, dollar volume was up quite a bit, but overall transaction volume, I think, was not all that much different than the prior year. So you had some large mega deals which contributed to the dollar volume. But it's the comment I made earlier about still relatively low level of DPI in funds and returns to the LPs, I think that was reflected in the fact that we didn't see the explosion in number of transactions per se. So again, with the IPO market we saw, and there's still quite a bit of dry powder in the market, I would have expected more activity.
Yes.
And, public companies were, in a good position to be active in those markets.
Yeah, and I couldn't agree with you more in terms of the elongation of transactions, certainly in the private M&A markets, where things were just taking considerably longer than one would think. That said, we leave here, of course, we go through the summer, things are relatively busy, we go into the third and the fourth quarter. Do you feel like that optimism or that kind of upward trajectory gave us some confidence going into 2026? And early on, what have you sort of seen in 2026?
Yeah, well, I think it gave us a lot of confidence in Q4 25. Globally, interest rates had been drifting down through the year. We started to see U.S. interest rates coming down in Q4. Public markets had been strong. So there's still, I'd say uncertainty about the ability of the public markets to stay strong. But similar to the way I thought about how the year might unfold in 25 earlier in the year, I was pretty convinced coming into 26 that you would start seeing more DPI and the markets were opening up. I know my colleagues in the capital markets world were expecting a good number of IPO or a good level of IPO activity in 26. Now, we all know 26 has not turned out so far to be quite what we thought it might be. It started in I'd say early Q1, a next release of a lot of the large language models, and we had and I'll always pronounce this incorrectly, but SaaS apocalypse, I guess they called it. And so that introduced a whole new layer of complication around valuations in the market, how you looked at companies from a diligence perspective, where was the disruption going to be, and we can go into a little bit more on that later, but it's certainly, for me, and now every company you look at in the software space, there is a certain amount, what do I not know that's going to come around the corner? And there's, whatever it is, 2,000 agentic AI companies out there. Maybe half won't make it, maybe 2/3 won't make it, but there's a lot of uncertainty around what you just don't know it's coming around the corner. It's going to threaten the company you're looking at or you're already in. And then, of course, unfortunately, the war has added another level of uncertainty. We're starting to see more inflation risk, interest rate risk. And so we're in a bit of a funny period right now.
Yeah, and so just staying on that theme, seeing what you've seen, both 2025 and early 2026, has the banks, to the extent you can speak about this obviously in a non-confidential setting, has the bank's sort of view about how it views the capital markets, the IPO markets, the M&A markets, exit markets, I guess, in general, changed, or how has it perhaps been modified by what we're seeing happening in the world?
Yeah, I mean, I can't comment on the bank's own M&A strategies. We sit with the bank's corporate development team, same physical space, and we obviously are close, but there is a pretty clear wall, a virtual wall between us. So even if I knew, I couldn't say, but I don't know. More broadly, though, I do think, I know that our investment bankers, and I know this with some other banks, the investment bankers coming into 26, as I said earlier, we're expecting a large volume of IPO activity and increasing M&A activity. The sense I get now from discussions and what we're in the early stages of seeing is, maybe SpaceX will go public, maybe one or two others will go public, but it's a bit of a holding pattern. There's just a lot of caution right now. I'm not a big SPAC person, but we've seen a few SPACs, and we're seeing people redeem rather than leave their cash on the table. We're seeing SPACs canceled. Or de-SPACs, whatever they're called, canceled. So everything just seems to be in a bit of a cautious holding period right now, which, again, as long as the macro environment remains the same, it's hard to see things changing materially right now.
Yeah, and just one quick note on the de-SPAC process. You're seeing a lot of cross-border de-SPACs, especially overseas in Europe, coming back. They are taking longer to get to close, and that is frustrating to the markets as well as to those that are trying to price those transactions. So let's just kind of stay on that theme. We've got 7 minutes left here. Liquidity options, valuations. Where are you seeing kind of valuations these days? Have you seen a market change between last year and this year, or at least the end of last year and this year?
Well, it's a bit of a bifurcation, I guess I'd say. So if you look at the AI companies, of course, the core ones, and the companies that are doing something really interesting with from a foundational model perspective, they are certainly and obviously seeing very strong, continuing strong valuations. Everything in the data center space seems to be on fire right now.
Or related, for that matter, cooling, other areas.
Yeah. And so I'm not sure how much of this you'd see in the US, but certainly in the Canadian market, with some of the US administration activities, there's a lot more of that nationalist sentiment, and so there's a lot more focus on where can people be investing to support Canada, and that could be the defense and aerospace sector. So that's a sector that continues to be quite I think hot, globally. So you're seeing a number of sectors that are seeing good activity, but broadly, I would say valuations are flat to down. If you think about the SaaS apocalypse, that's created, we all saw valuation, so the public companies drift down pretty dramatically in the earlier part of this quarter. I don't see that changing in the near term. And if you're a company that's still seeing slow growth with losses, it's a brutal market right now. It's still a brutal market right now to raise capital in. So if you're seeing strong growth generally and profitable or near profitable, it is a different market, although valuations, I think, are still sort of tempered. But if there's a large mass of companies that are still losing money, not seeing great growth, even if they're seeing some growth, and it's challenging.
So we've talked about the M&A markets, we've talked about the IPO markets, we've talked about the CVC and venture markets. Let's sort of switch a little bit to private capital, secondary offerings, alternative kind of exit strategies. As we talk to our clients, we're talking a lot about that, frankly, because of what we're seeing in the IPO markets and the M&A markets. What are you seeing in that regard in terms of how your portfolio companies are reacting to those types of potential tools?
Yeah, not only portfolio companies, but funds we are in discussion with or funds we are LPs in. You're seeing a lot more SPVs, so as fundraising cycles are elongated, funds are turning to SPVs, both for some of their existing portfolio companies, but also new investments in anticipation of rolling them into a fund when it finally gets to a close. Secondary markets continue to be, relatively speaking, strong, I think. On the buy side, and so I think the secondary markets, especially in situations like we're in right this year, are increasingly important. for a lot of investors who need to see some liquidity. And so everything we've seen in the secondary market is a continued increase in the amount of capital available. SPVs, we see more and more of the SPVs. Continuation vehicles, I don't think we've seen an increase. We saw quite a few of them in 25 and 24. I don't think we've seen an increase, but they're still very much out there. So,
Are there other tools that you're considering, or that, as you talk to your portfolio companies, they're sort of considering? And this audience is obviously about entrepreneurialism, so anything you can share on that front in terms of matters that are, I won't say unique necessarily, but tools perhaps from the past, or things along those lines that might be helpful, private capital perhaps, or something along those lines?
Yeah, it's a challenging one to answer. You know, it's not, I wouldn't say it's a tool, but if you're a company, it's get profitable.
Yeah.
As much as you can, preserve capital, and make sure you have an AI story. Certainly, there are a lot of companies now that, and this has really accelerated, I think, coming out of Q1 or coming towards the end of Q1, where you really need to have a story about how AI is going to impact your internal operations and how AI is going to make its way into your product as a software company. And we've seen a company right now, recently in the Canadian market, that as of about 4 weeks ago, when they started using Claude Code, really have tried to internalize it and now see themselves using Claude over the balance of this year to do most of their development work. And they're looking at downsizing their internal cost structure pretty materially. We'll see how all this unfolds, but again, I think there's a recognition that you need a strong, very sound AI story right now.
Yeah. So we got about 30 seconds left. Thank you for your time as well. We hope you enjoy the balance of the conference. Any final words for this audience?
I don't mean to be flippant in a market like this, but I guess my final word would be buckle up. It's going to be, it's so uncertain right now. It's just hard to predict what we're going to see in the markets. It's hard to know how long the war will go on, where the energy market's going, and then you counterbalance that with the level of investment activity you're seeing in certain sectors, as I referred to earlier, some data centers, defense, aerospace, critical minerals. So it's just a very interesting market for us right now.
Barrie, thank you very much. Thank you to GCV. Enjoy the balance of your conference.
Thank you.